Sentiment is pretty stretched. Everybody's long. You really think there are that many people who are still non-believers in this? Now, I know there are some out there because I hear from them, but you really think there are that many?
Yes. I mean, I think there's a couple of reasons. One is many people think the stock market's very concentrated and the FANGs or the Mag 7 are expensive. But, NVIDIA's free cash flow yield is 3%. It's the same as the S&P. It's actually not expensive. And I think there's still this inflation mindset that inflation is stalling or could come back. And so investors are kind of inclined to short the market. And I think the best evidence that sentiment's still pretty negative is I hear people talk about the market being expensive, but outside of the FANGs, it's trading at 15 times forward. I mean, that's never been an expensive multiple. It's just people look at the price appreciation of the market and because they may not have participation, think it's a bubble.
You don't have any concerns at all that it might be, especially, stocks like NVIDIA, which, as we say, seemingly, went from $1 trillion to $2 trillion in market cap, quote unquote, overnight?
I mean, in some ways, I think, stocks rise rapidly when either estimates change or they want to reprice the future growth. What's interesting is NVIDIA's free cash flow was $7 billion a year ago. It's now close to a $50 billion run rate. So it's gone up by, 7 times, and the stock price hasn't risen by that much. I don't think we will have a bubble until the consensus declares there's no bubble and there's no risk. And then that's when we're likely in a bubble. But I think a lot of folks raising the prospects that this is a bubble means it's still early.
The market seems to be giving the Fed the benefit of the doubt that though it might not cut as early as it once thought, it's going to cut at some point this year. There has to be the expectation in this bull run that cuts are coming sometime this year, I would imagine. What happens if they don't?
I mean, if the Fed doesn't cut, I think it would pose quite a lot of risk for the stock market. I don't think the Fed's going to hesitate just because the stock market's risen or the ISMs have turned up. The Fed's policy rate of close to 5.5% is the highest policy rate in the world for any developed country. Look at the U.S. 10-year. It's at almost 4.5%. Germany's 10-year yield is 2.6%. I think that the bond market itself is telling us that the Fed is overly restrictive right now.
You think they should cut in March?
I think the probability of cutting in March is higher than what's being priced in. And a lot of it will depend on what February CPI looks like, which comes out March 12th. But, we think there are some anomalies in the January CPI, including poor seasonal adjustment and the fact that auto insurance is actually accounting for almost more than half of the rise in the supercore services number. And if those start to show improvements, I think whatever sort of hot CPI we saw in January and the repricing reverses to a large extent.
What happens if it's not March, and what happens if it's not May?
If it's not March and May and it's not even looking like 2024, I do think it puts pressure on stocks. But if it's a Fed that isn't satisfied with 6 out of 7 good inflation reports, and they suddenly move this, the guidepost has to be 9 out of 10, I think the stock market gets impatient and just rallies anyways. But it just really depends on the path of inflation.
The other, issue, I suppose, as some are talking about, is this whole loosening of financial conditions because of this AI boom in the stock market. Do you think that's an influencer on the Fed? And on one hand, we're all revved up as bulls because we look at NVIDIA going up every day and we're like, wow, this is incredible. Look at these new records. But there's a price to pay potentially for that. And that is perhaps putting off these rate cuts further than we're able to tolerate.
The AI boom is creating wealth, right? People who own the stock. But as you know, that isn't been translating into necessarily consumer spending incrementally, especially for the average American. And if the AI boom is actually replacing the labor market, because that's really what is being targeted, right? Turning a service job into a piece of silicon, which 98% goes to NVIDIA, that's actually deflationary, and it's actually deflationary to the labor market. So I think the Fed doesn't necessarily have to be worried if AI stocks are actually booming.
So to recap, Mr. Tom Lee does not believe we are in a bubble. He said the Magnificent Seven PEs are justified, and outside of the Magnificent Seven, the PE multiples are 15. So that's pretty cheap. The probability of a March cut is higher than what's being priced into the market currently. That's what Mr. Tom Lee said. He also said there's more upside ahead for stocks, so let's go. If the Fed doesn't cut rates this year, the stocks will feel the pressure and pose a lot of risk to the stock market. He says the bond yields are telling us that the Fed is overly restrictive, and you can also compare that to bond yields around the world. We are the highest by far. He says there are reasons in the January CPI report that could make it an anomaly. He says it's pushed up by auto insurance and pushed up by price increase implementations. He said this prices should reverse in the following month, so the CPI should come down in February as opposed to being hot in January. Seems like everybody on CNBC and everybody around is bullish, but they all have facts to back them up. We have just started an AI revolution, guys, which we can't even fathom how much it's going to change the world around us in the next coming years. As of me, I'm fully invested right now, and I'm not worried about a recession. I'm ready for the AI revolution. Hope you guys enjoyed the video and learned something. Catch you in the next one.